What is up, you guys? Michael here. Let's talk about investing in the stock market. For many new investors, it can be an extremely daunting task to take your hard-earned money that you've spent many hours working for and investing it in something like the stock market that you may not understand that well yet. So it is critical that you guys have a good foundation before actually putting your money to work for you. One of the most important things that you can do that I think a lot of people do not do when they first start investing is map out what goals you have in life in general and make sure that whatever you guys are looking to invest your hard-earned money into, that those investments and the outcomes you're looking for align with those goals. So if you guys stick with me throughout this video, we're going to go over many of the reasons why you should invest and frankly why you need to invest, and also discuss things like various forms of analysis such as technical and fundamental analysis when evaluating stocks to put your money into. Now, before we begin, if you guys don't mind giving the like button just a little bit of love below, just needs a little bit of love for the almighty YouTube algorithm. Trust me, I really appreciate it and it genuinely helps me out. All right. So first, let's just touch on why investing in general is critical to your long-term financial success. Some of you may have seen a video I did in recent months. It was titled "Savers Are Losers." And I don't want this title to be misleading because saving your money overall is a positive thing, certainly beats overspending in certain areas of your life. But saving over the long term is actually a losing mentality when compared to investing, and here's why. For starters, we need to talk about inflation. Inflation is the decline of purchasing power of a given currency over the course of time. Now, while there can be many contributing factors to what causes inflation over a given period of time, one of the biggest contributing factors is actually the increase or influx of dollars or said currency that is available in a given market. So when the Federal Reserve, part of an extension of the US government, is printing additional dollars, that causes inflation because the more money that is available in the market actually decreases each individual dollar's purchasing power. Now, keep in mind that when I say the Fed is printing money, it's no longer so much about printing physical dollars because the vast majority of money that is created new by the Fed is actually credited in the form of bank deposits. Now, this is most often part of what's known as monetary policy. The main goal of monetary policy is to stimulate the economy and increase the amount of money that is available to borrow, spend, and invest. This is one of the tools used by the federal government that is used to help end or prevent recessions. The point I'm getting at is with inflation, every single dollar that you have that's not invested is technically losing buying power, meaning things that you buy today for $1, in years to come, that $1 is no longer going to go as far as it once did, and those items are going to be increasingly more expensive each year. Over the past 60 years here in the United States, there has been an inflation rate over 3% on average. So technically speaking, the money that you are storing in a savings account or the old stash under your mattress for a rainy day mentality, that money is actually losing value over time. So assuming a 3% inflation rate, if you were to use $100 today to buy something, 1 year from now, that object would cost around $103. In 10 years, it would cost $130.48. And in 30 years, it would cost an astounding $235.66. So when you hear me say savers are losers, I'm not telling you that saving money is bad. I'm quite literally telling you that the longer you save money, you're losing value over the course of time, relatively speaking. Now, once I understood this, it completely changed my mentality of the overall risk of investing in general. I now have the perceived mentality of it is far more risky to actually save a bunch of money versus investing it. So let's briefly talk about the S&P 500 index, which originally began in 1926 as the composite index comprised of only 90 companies at the time. According to historical records, the average annual return since inception in 1926 through 2018 is approximately 10 to 11%. The average annual return since adopting 500 stocks into the index, which was from 1957 through 2018, was roughly 8% year over year. So looking at the big picture, even if you just dump your money in an index fund, it makes far more sense to collect on that 8% average growth year over the course of your lifetime than it is to just save money and honestly lose 3% year over year due to inflation. And this brings us back to the importance of setting goals. What are your goals in your life? And we need to make sure your investment strategy aligns to those goals. So let's just touch on a few of the basic ways that most people invest in the stock market. A few of the most common ones are investing in individual stocks. And this is quite literally buying a share of the company where you become a part owner. You can also invest in index funds. One of the most common ones is known as the S&P 500, which we just touched on. Now, investing in index funds will essentially hedge some of your risk by investing in more of the broad market as a whole versus individual stocks. Next, we have mutual funds, which I personally try and stay away from, but for you, it might make sense. Investing in mutual funds basically means you are paying a mutual fund manager to manage a pool of money from many investors themselves, just like you, who then invest those dollars into various things such as stocks, bonds, and debt. We also have the more common ones that most people view as their sole retirement accounts now, which would be IRAs and 401ks. For both of these options, you can invest in a traditional account or a Roth account. For traditional accounts, you are investing tax-deferred income to let grow tax-free, but don't let that fool you, because when you take withdrawals in retirement, you will pay taxes down the road. And for Roth accounts, you are actually taking your taxes out today based on your marginal tax rate, and you are letting it grow truly what I would call tax-free. So when you actually make withdrawals during retirement, you are no longer paying income taxes on those dollars. In order to start investing, you guys will need to open up one or multiple online brokerage accounts. Now you can Google this and find many different online brokers that are available today, but some of the more common ones are TD Ameritrade, Charles Schwab, Robinhood app, Fidelity, Vanguard, and many more. Some of these online brokers will be better suited for those looking to invest in IRAs or mutual funds or index funds, or invest in individual stocks. You're just gonna have to do some research and find out which one or ones are right for you guys. So now that we're ready to invest, let's talk about investing in individual stocks, or I guess you can also apply this to index funds, but the two most common tools or analysis that people use are fundamental analysis and technical analysis. Both of these strategies are used in an attempt to predict future stock prices. Fundamental analysis is what has been used by famed investors such as Warren Buffett, in which they look at many different factors into an individual company in order to predict what the true intrinsic value is, and they try to purchase these companies when they're undervalued in the market. Within this strategy, one would study the overall economy, industry conditions, company performance, earnings reports, and their leadership. Through this analysis, one would attempt to predict if a company is currently undervalued today and base their investments on these findings in hopes that in years to come, the stock price will actually increase dramatically over time to go above and beyond what they believe is the true intrinsic value of the company. Technical analysis, on the other hand, is what traders actually use to identify buying opportunities by looking at statistical evidence and history on trends within stock price and trading volume. This strategy does not rely on fundamental analysis to identify the stock's intrinsic value necessarily, but instead uses stock charts to identify patterns and trends that they use to best predict future stock prices. Most traders using technical analysis are usually trading short term, so either day trading or doing swing trades, which can last days or weeks. Fundamental analysis is usually used for investing long term. Now, I am not a financial advisor of any kind, but I would recommend for those that are just starting out to start with fundamental analysis. And start by looking at and investing in companies that you truly believe in and honestly you understand their business plan and their vision. Take a company like Apple, for example. If you love Apple products and services and you have been a customer for a long time and foresee yourself being a customer for many years to come, and you believe in their rapid pace of innovation, you see Apple products all over the place. You see almost everybody that you know probably has an iPhone or some MacBook or iPad, one of their products or services. And again, you truly believe in the longevity of the company, then I would encourage you to start with a company like that and do some fundamental analysis, do some background research, and try to get the stock at a half decent price and just ride the wave for the long term. Now, I can almost guarantee that everyone out there will make a mistake or many mistakes along the way when it comes to investing. And I encourage you guys to learn as fast as you can from your mistakes and try to not repeat silly mistakes, but ultimately just know that mistakes are a part of the journey and your goal is to invest for long-term wealth. After all, this is not a get-rich-quick scheme. Many people who trade in the stock market with the attempt of getting rich in a very short period of time, the vast majority of those people fail miserably and end up losing a lot of money. I'm not saying that's not all cases. You do see successful day traders out there, but for people like myself, I look to invest long-term and to build wealth, and the way to do that is to invest continuously over the long term and take advantage of compound interest. Did you know that out of Warren Buffett's $84.5 billion net worth, $84.2 billion of that was accumulated after his 50th birthday, and $81.5 billion of his wealth was actually accumulated after he technically qualified for Social Security in his mid-60s. So that is the true power of the compound effect and investing over the long term, and stresses the importance of starting when you're younger and just continuing to build as you go. Now, can any of us replicate the exact outcomes that Warren Buffett has achieved? Probably not, realistically speaking. But what we can do is attempt to replicate the overall investment strategy and not let short-term market fluctuations and downturns affect our overall long-term outcomes. Hopefully you guys found some value in this video. If you did, please don't forget to like and subscribe below. But more importantly, if you have any comments or questions, do not forget to leave them in the comments section right down here. And honestly, I would love to hear from you guys. What are you guys investing in? Are you using fundamental analysis, technical analysis? Are you investing in mutual funds, index funds, individual stocks, Roth IRAs, traditional IRAs? I want to hear from you guys, so don't be afraid to drop your comments below and maybe we can get some conversation going. Thanks again for watching, guys. I hope to see y'all again soon.